Okay, this is our Math at Work 11 lesson. We're going to start now looking at lessons on borrowing money. So today's lesson is going to focus on credit cards. Another lesson is going to focus on other types of loans. And then that's actually the end of our financial math unit. Okay, so this one, there's not as much intense math so much involved as it is just kind of understanding how things work and what numbers we need to be taking a look at and certain properties of credit cards. So it's more just kind of like going through the material, discussing it, being able to kind of analyze what's happening. There's a little bit of math obviously associated with it by looking at is something actually financially worth it, I guess you could say, in terms of the credit cards, as well as talking about how those interest rates are going to work. And we'll kind of get into it a little bit later. Okay. So like I said, we're going to focus mainly on credit cards in this particular lesson. So before we even talk about that, we can just kind of briefly talk about how, different ways we're able to spend money, right? When we go to buy something, right, we have options, right? Cash, debit, or credit, right? That's kind of the three basic options that they've given to us. And if we kind of sit down for a second and just think about, well, what are some advantages and disadvantages to all those, those types of paying, right? So some people might advocate for the fact that, oh, well, if you're really trying to watch your spending, you should have a cash-only budget, but we'll just quickly look at that before we get into focusing on credit cards. So when we talk about cash, like I said, there's a lot of people that like to say, oh, if you're trying to really work on your budgeting and your spending, have a cash budget, because one of the advantages is that it's an easier way to keep track of your budget and spending, right? If you've got a certain amount of money in your wallet and then all of a sudden you see that it's gone, it might curb things that you're spending money on, right? Cash is also accepted in most places, right? We even think about our own cafeteria. You can only use cash there, okay? But obviously there's some drawbacks to that. I mean, one being that you don't actually get, most people aren't being paid in cash, right? Their biweekly salaries aren't being paid to them in cash. So it would mean like trips to the bank. It also results in having a lot of change. Not everything comes out to a nice even $20. So you end up having a lot of change lying around that you're carrying around. Therefore, it's easier to lose, right? And then even if it does get lost, it's gone forever, right? There's no way that you can go, oh crap, I just lost my weekly envelope of money. Now what, right? And then, to tie in this current situation, you've got a lot of places right now requesting that people not use cash simply because of germs, right? I mean, it's being passed from hand to hand to hand. You don't know whose hands it's been in, right? So there's that, germaphobe, not really germaphobe, just like germ aspect of it, right? Money it can be considered kind of dirty, right? In that sense. We can then talk about debit, right? Obviously, debit can be relatively quick and easy to use, especially now with the addition of tap. Then you're not, another advantage, you're not carrying around any sort of change in your pocket. It is secure because of the fact that you actually have to put in a PIN, right? You can't have somebody just grab grab your debit card out of your hand and then, oh, there goes $20, like they could if you were just holding out a $20 bill, right? And if you do lose your debit card, well, you can get that replaced, right? And there's security measures that kind of go with that. The disadvantages of using debit is kind of going with the savings aspect, where it can be harder to track your spending, right? Not everyone is actually analyzing. We did that budget assignment. I made you try to look at your own bank account or look at somebody else's bank accounts and actually kind of analyzing, oh, this is where my money is going, right? Not everyone does that. And then oftentimes it's like, well, you just got paid and all of a sudden there's no money left. And you're like, well, what happened there, right? Because you're not physically seeing it go. You just know that you're tapping your card, okay? Debit is not always accepted anywhere, or if it is accepted somewhere, it might come with a fee, right? Some vendors have to charge, they'll charge you like a 50-cent fee if you're using debit instead of cash, okay? And then even in terms of what we talked about with our banking options, is that if you only have so many transactions per month and you're using a lot more debit transactions, you could end up resulting in more fees being paid just from your bank because you've used that. Whereas if you did a cash-only budget, you just took out cash once, that's one transaction, and everything else is just done via cash, okay? With credit cards, and this is where we're going to be focusing, obviously an advantage is that credit cards are accepted almost everywhere, including like online, right? For online shopping, you can use credit cards. You can't use cash, or not all debit cards either. Credit cards, again, they're quick and easy to use. Credit cards, the other thing that's great about them is it allows you to build your credit, right? So as you get older, you might want to apply for a mortgage or a loan for a car or something else where you might need to get money. And what you do that, when you do that, you have something called a credit score that kind of tells the person approving your loan how reliable you are in paying back money, right? So that'll include things like, well, how much money are you making and how much other debt do you have, right? But if you've kind of proven yourself that you can make payments and keep up on them, that increases your credit score and they're more likely to give you money in that sense, all right? Again, another option, another advantage with the credit card is that, of course, it's a larger amount of money that you have available. So in emergencies, you can say, oh, well, great, at least I have this money on a credit card that I can use to fix my car so I can get to work or, pay this vet bill, right? And a lot of credit cards also have these built-in perks or benefits, right, that you don't get necessarily with just your debit card. And we'll be talking about those today too. Right, so like you can earn air miles or you can get cash back on purchases, that kind of a thing, okay? Obviously, disadvantages with credit cards, again, it's that easy to overspend if you're not really tracking, looking at your statements carefully. I mean, and a lot of time people treat credit cards as if it is really money. So, well, I have this money. Well, you don't. You still have to pay it back at some point. But, that can be hard for some people to deal with, money available equaling money that you have to spend. Obviously, with credit cards, you get charged interest. So it's not just, I'm spending this $400 on something. You'll end up paying more than that if you aren't able to pay it back right away. Credit cards often come with additional fees, like a yearly fee to have the credit card, and they can get tricky to pay off if you kind of get stuck, right, in the minimum payment cycle. Okay. Now, obviously, we know there's other types of payments like checks or PayPal or e-money transfers, right? But we're not going to go into as much detail with those. Checks are being very phased out lately, just with the use of all the online stuff. PayPal's probably and e-transfers are more common now. But again, these two are hinging on the fact that you actually have a bank account set up and it's almost just working like a debit account anyway. Okay. So again, we are going to focus on credit cards. So I've just kind of got a selection of different cards here, and there's just a couple things I want you to notice as we go through, right? So one, you kind of have three main companies here, right? You've got cards that offer Visa, right? So notice most of these are bank cards, right? They're credit cards through a bank, but they're operated by the following credit card companies, right? So in this case, Visa, or MasterCard, and then the less common one is your American Express. Now, with American Express, that one will typically offer you better travel rewards. However, it's not accepted a lot of as many places, right? So sometimes you'll have to ask, do you take American Express here? And they'll say no, and then you'll have to find a different way to pay. You won't be able to use that one, right? And again, a lot of these have different types of rewards, right? So you can kind of see these ones with the Air Miles logo in there, right? They would offer you Air Miles rewards if you use their cards, right? I think Avion is also a travel rewards one as well. You've got this one that's from President's Choice, right? That's going to give you more points in terms of like PC Optimum type thing, right? So you can get money back, or you can use those points to get groceries and things like that, right? These two are actually store credit cards, right? They're not actually given through a bank. So this one's through Hudson's Bay, and this one's through Canadian Tire. So there's a lot of stores that will say, okay, well, we have our own credit card, and if you apply through our company and use our credit card, we'll give you a discount on items, or you can have better promotions, that kind of thing, right? So the incentive is there more about, like, if I buy, say I have this Canadian Tire credit card, if I buy things at Canadian Tire, I can get discounts, right? But you don't necessarily get discounts on anything else, only at Canadian Tire or, like, only at Hudson's Bay. Okay, so those are, again, different types of credit cards that we'll be kind of looking at. Some key terms when we discuss credit cards are obviously credit limit, which is the maximum amount that's on your card that you're able to spend or borrow. And after that, they'll say, nope, you're not approved for anything bigger. An annual fee is the fee that you're required to pay each year for having the credit card. Okay, not all credit cards have these annual fees, but a lot of them do. Okay, a minimum payment is what we talk about as the smallest amount of money that you have to pay every month in order to be considered in good standing with your credit card company, right? So they'll often give you an option of you either have to pay like this percentage of what's owing on the bill or a flat rate, whichever is bigger, and they'll tell you on your bill what it is you need to be able to pay, and then they'll also tell you how long it'll take you to pay it off if you only make the minimum payments, and we'll get into that as well, okay? So the first thing we're going to look at is analyzing rewards for value. So as already mentioned, a lot of these credit cards offer a type of reward as an incentive for you to use their card and therefore give them their money to pay their yearly fee. Right? So some examples would be those cards that say, okay, if you get this card, you can earn air miles for every however many dollars spent. Right, and then you can earn air miles quicker if you use your credit card more often. Or you've got like the Scene Visa card where you can earn Scene points if you use their credit card, right? So you can get discounts on movies. Or sometimes it's discounts at a particular store, like I mentioned with the Canadian Tire or the Hudson's Bay. Or sometimes it's just a cash back where it's like, oh, well, 3% of your purchase on groceries you'll get back, or 2% on purchase of gas, or 1% on other different, like just general shopping you'll get as a percentage as cash back at the end of the year, right? But again, is it going to be worth it if the cash back isn't going to actually counteract the actual fee for the card itself? It's kind of like a Costco membership where it's like you might save money, but you also had to spend money to be a member, and did you save more than what it cost you to be a member? If you're not, it's not worth it, right? So that's what we're going to take a look at, some analyzing. So let's take a look at this first one here. Okay, so here we are analyzing just again this idea of like cashback rewards, right? So Eric pays an annual fee of $85 for his credit card. He pays his balance in full, right, each month, so he's not paying any extra interest or anything here. And he gets 1% cash back on purchases. He spends an average of $400 per month. Is this card worth the cost to him this year, right? So what we need to look at is, all right, well, what is he going to actually get in cash back over the year, and how does it compare with that $85? So let's do that. The answer's already there, but let's do it this way. Okay, so again, our cost, right, our yearly fee is that $85. Okay, then we look at, well, what was the spending? I'm going to have to kind of go back and forth here, right? So it says we're spending $400 a month, okay? So in terms of spending, we have $400 per month. And since this is a yearly fee, we want to look at that. What is that for a year? So let's see. So our yearly spending is going to equal that $400 a month times our 12 months in a year. So that's going to be $4,800 that's spent in the year on that credit card. That, again, if they're paying it off every month, there's no interest being added on to that, right? That is what they're spending. And then what we need to figure out is, well, they're going to get 1% cash back of that. So what's 1% of this? Right, so we can calculate, okay, 1% of $4,800. Well, that means you take your 1%, turn it into a decimal, divide it by 100, so 0.01, multiply it by that 4,800, and that gives you a value of $48. Right? So at the end of the year, they're going to say, oh, congratulations, you've earned $48 on your cash back. Here's $48 from all the money you've spent over the course of the year. And then a couple days later, they'll say, oh, please give us our $85 for the ability to use this cashback credit card. Is it worth it? No, right? Because it's costing you $85, and then you're only recouping $48 from that yearly fee, right? You might be able to get a no-fee credit card that that just doesn't have the 1% cashback, but at least it's no fee. Okay, so that's one of the ways that we would analyze a benefit there, right? So again, you see the exact same work there being done, right? So the $400 times the 12, there's how much we spent, 1% of that, and then do the comparison. Okay, let's look at another one, like a travel rewards, right? So again, travel rewards are tricky because things like an air mile or whatever type of travel point, it doesn't equate exactly to a dollar value, but it might have an approximate dollar value if you look at, oh, okay, well, I know I can get this flight for this many air miles, which usually costs this much money, so I can get an approximate value. Keep in mind, too, though, that when you use air miles to book flights and stuff, it only works for the actual cost of the flight itself. It doesn't include things like airport fees and taxes, so you're not getting a 100% free flight. So what might have been like, oh, this flight to Toronto would have cost me in total $350. You use your air miles, it still might cost you $100 when you go to pay the taxes and like all the other fees. Just word to the wise. All right, so let's look at this travel rewards one. So Sally pays an annual fee. I'll change that in a minute. So Sally pays an annual fee of $144 for a card that gives 1 reward mile for every $15 spent. She could have a card with no fee that gives 1 reward mile for every $20 spent. Right? Sally thinks that she'll spend about $2,000 a month on her card, and she pays her balance in full each month. The value of a reward mile can be between 5 cents and, again, that should have a decimal in it, 12 cents. All of the typos are coming out. There we go. Is this card worth the cost to her? Okay, so again, we need to look at the value. So at the $144 fee, we're getting one mile for every $15 spent, or we can have a $0 fee and we'll get 1 mile for every $20 spent. Okay, we're thinking spending $2,000 a month, so we're just going to kind of go back and forth on this one for a second. All right, so this is what I have so far, right? So our $144 fee, we get 1 mile for every $15, or no fee, we get 1 mile for every $20. We're estimating spending $2,000 a month, right? So if we multiply that by our 12 months, we'll get what we're approximately spending over the course of a year, right? Which is going to end up being $24,000. Okay, so that's how much we're spending over the year. So to figure out how many miles we would get with this one, right? So if we look at the fee card, we would take our $24,000 and divide it by the $15 to figure out, well, how much are we actually going to get in terms of how many miles, right? So that means we would get 1,600 miles, okay? If the miles are worth between 5 cents and 12 cents, we can look at kind of the range of what's the monetary value of this 1,600 miles, right? So if it was on the low end, right, which was at the 5 cents a mile, we would take that 5 cents and multiply it by our 1,600, which means it's only worth about $80, which if you only get the low end, that's certainly not worth the $144 fee, right? If we looked at the high end of the value of each mile, which was the 12 cents, you get a value of $192, right? Which is a little bit more, but does it really balance it out? I'm not really sure, right? I would argue that it's not worth it for the year. You can't guarantee that you're going to get the high end of the value all the time, right? And even if you do get the high end of the value, you've really only saved like $50, right? Because of the way that it's structured, right? Now, if we looked at the $0 fee, right, our spending is the same at $24,000 a month, but now we're not going to get as many miles, right? Because we're only going to get a mile for every $20 spent. So if I take that and I divide it by the $20 instead of the 1,600 miles, we would be getting 1,200 miles. So we do get 400 less miles. But what does that equate to in terms of actual dollar value, right? So if we change, so the low end and the high end prices are staying the same, but we would change the mile values, which would change the monetary values. right? So 1,200 times 0.05 is 60, and then 0.12 times 1,200 is 144, right? So clearly it's better to just have the no fee option, because by looking at the amount of money that they're spending and how many miles they would get, right? In this case, right, if you only get the low end, it's worth $60, but you kind of save $60. When we looked at that other one, where even on the high end, you only would have saved $50. So kind of what's the point, right? Maybe if you're spending more than $2,000 a month, right, on that credit card, maybe then it's worth it for that fee. But, or if you were getting a lot more miles for that same amount of money, then maybe worth it. But the way it's set up right now, it doesn't seem worth it. Just looking at that particular reward, right? Maybe this also includes a bunch of like travel insurance, you know, other stuff that we don't know about, but just looking at it from this point of view, not worth the fee. Okay. Again, there's all that work that you can take a look at, okay? The next thing to really talk about with this is your interest rates on your credit cards, right? This is the kicker when it comes to any sort of credit card situation, right? If you have a balance owing on your credit card, you're going to get charged interest on the cost of everything you buy, right? So really using a credit card, everything that you're buying, if you're not going to be paying it off immediately right away, is costing you more money, okay? So like I said, when we talk about carrying a balance, it means you're not paying off the entire, you get the bill and it's like for $1,000, you're like, I don't have $1,000, I'll give you $100. Okay, well that's going to keep them off your back because you're paying them back, but now you owe interest on that $900 that's left. And then if you spend more, you're going to owe interest on that as well, right? And even if you keep paying them $100, the interest is still being tacked on every time, right? So one of the things that, you know, can help avoid getting into trouble with credit cards is really only using the credit card if you have the money to pay it off, right? You can use the credit card to be able to get the advantages of whatever card you have, but have the money ready in your bank account to when you get the bill, go, oh yeah, here's that money to pay it off, right? Obviously that doesn't work when it comes to emergency situations, but you should still be budgeting for emergency situations anyway. So even if you're using the credit card, you'll still be able to pay that off relatively quickly. And the faster you pay it off, the less interest it's going to cost you, okay? Now, we've been looking at investments where the interest rates on those investments are been like, you know, you earn 3%, you earn 2.7%, right, 1.4%, right? They don't give you a whole lot. However, when you're borrowing the money, you look at your credit and it's like super high interest rates, often up to 19%, right? So borrowing money, the interest rates are really, really high. Investing money, not so much, right? Just one of the very frustrating things when it comes to banks and stuff like that. Now, one of the things that is, you know, something to know about when it comes to credit cards is that you have this interest-free grace period a lot of the times, right? Which is, again, so it's an interest-free period, which is also known as the grace period, where when you make a purchase on your credit card, they don't start adding the interest right away, okay? What happens is with that grace period on new purchases, the grace period starts on the last date that's included in your regular monthly billing cycle, right? So if your bills come on the 30th, right, if they send you the bill on the 30th, right, you have 21 days from when they send you that bill to pay off the entirety of your card, and there'll be no interest charges to you. If you don't pay it off, that's when they start charging you interest, and that'll happen, right? So if it was like they send you the bill on the 30th, you basically have until the 21st of the next month to make your payment in full. If you don't make the payment in full by that point, then that's when they start charging interest on that amount. Okay. So again, that 21-day grace period on new purchase applies even if an outstanding balance has been carried forward from the previous month. Okay. So that's where they kind of like give you that chance to pay it off, okay? Now, the only thing is that only works for purchases. If you're going to use your credit card as like a cash advance, like take it to an ATM and pull cash off of your credit card, or you know, online, you've got your credit card linked to your bank and you transfer money from your credit card to your debit account, that's kind of like a cash advance. That doesn't qualify for any sort of grace period or interest-free. The second you do that, they're starting to charge you interest, okay? Just be aware of that. So let's suppose that I was using a credit card and I made a purchase on April 5th. And my statement covers transactions that I made from April 1st to April 30th. Okay? What is the last day that I can pay my bill and still not to have to pay any interest on that? Right? So this is kind of like that example I was just talking about, where I am billed on the 30th, right? So they send me my bill on the 30th, and that purchase, even though it was on April 5th, right, it's not 21 days from April 5th, it's 21 days from the billing cycle. So that purchase on April 5th fell within that billing cycle of April 1st to 30th. So when they send me the bill on April 30th, from then I have 21 days, right? So if I take my April 30th and I add 21 days to that, May 21st is the last day that I can pay the bill without paying any interest on purchases for the month of April. Okay? If I wait after that, I'm starting to pay interest. Okay? And I mean, even technically, if the 21st kind of goes by, right, really it's more about the 20th, I guess. I should almost change that, but the 21st day is like that. Okay, now we're going to start charging you interest if it's not paid. All right, so we didn't really talk about that on the board. All right, when it comes to your minimum monthly payments, right, you're not required to pay off your entire credit card in full, obviously, but your minimum monthly payment is the minimum amount that you have to pay every given month, so if you're carrying a balance on your credit card, so that way the credit card company knows you're still paying, you're doing something to work it off. Okay, if you don't pay the minimum amount by the due date, then your credit score could be lowered, right? They start reporting that, well, you're not paying them back, or you're not paying them back the right amounts, right? And that's going to have an effect on your credit score and trying to get future loans for vehicles or for businesses or a home, okay? Or even just rental, right? Some rental companies are now even looking at your credit score, okay? Now, your credit agreement, right? So your credit card company will have in the original documents how much how your minimum payment is calculated, right? A common method is either a flat dollar amount, like, okay, just pay us $10, or a percentage of what your account is, right? What's on your balance, whichever is bigger. Okay, so if you only have $90 that you spent, 10% of that is only $9, right? But they're going to ask you for whatever's bigger. You're going to have to pay the 10, right? But if you had $200 on that balance, right, 10% of $200 would be $20. 20 is bigger than 10, so they want the 20, okay? So just keep that in mind. The other thing to really keep in mind when it comes to minimum payments, we're like, oh, well, it doesn't cost that much money. The minimum payment is only this much. But because they're still charging you interest on your outstanding balance, using only, like, the balance is still going to get bigger, right? You might not be spending anything anymore, but it keeps ticking up how much you owe them, and minimum payments really only just keep them from, kind of coming after you, really. So it's going to take you a long time to actually pay that off, okay? And won't get it too much into detail, but I'll kind of give you an example in a minute. So let's take a look at this one, just in terms of trying to figure out monthly payments. So let's say Amy has an outstanding balance of $2,000 on a credit card. So that's how much she currently owes, is the $2,000 with an 18% interest rate. Okay, her minimum payment is $10 or 2%, whichever is bigger. Okay, what is Amy's minimum payment? Right? So again, a lot of people kind of look at these things like, oh, minimum payment of just $10, but remember, it's or the percentage, whichever is bigger. So if you've got a $2,000 balance and it's $10 or 2%, you need to figure out, okay, well, what is 2% of that balance, right? The 18% interest at this point doesn't really come into play. That's how they're going to charge you interest. The question isn't asking us how much interest she's accruing. It's just, what's her minimum payment? So what's 2% of $2,000 is the question we're being asked, right? So turn your percentage into a decimal. So that's 0.02. Multiply it by that balance, okay? And so 2,000 times 0.02, you get $40, right? Which one's greater, $10 or $40? $40. her minimum payment is $40, not the $10. Okay, because it's whichever one is bigger. Okay. So there's that one. Right. Again, a very important note when it comes to this, just by paying minimum payments, it will take you a ridiculously long time to pay off a credit card at such high interest rates, okay? So we're not going to get into the crazy calculations. I'm going to ask you to do some little calculations, but nothing like the intense ones that the companies would use. But they always tell you this. If you ever get a credit card, you'll get a statement, and it will tell you what the payment is, and it will say, if you only make minimum payments, it will take you this long to pay off this card, right? Pay off this balance. So in this situation, if she only pays the $40 every month, it's not just like, oh, well, I owe $2,000 and I'll just divide it by 40 and it'll take me 50 months, which is like 4 and a bit years. Yeah, not going to happen, because it's not just what you owe on the balance, it's also with the interest that's being compounded daily. Every day you don't pay it off, right? So in this example, it's actually going to take her 30 years and 10 months to pay it off, because the $40 really only covers like the interest plus a little tiny bit of that original amount, right? So in the end, instead of just paying back $2,000, she's going to end up paying back $4,931 in interest, right? So the thing to do is that don't get suckered in by just, oh, the minimum payment is this, that's what I'll pay, right? If you need to, okay, fine. But if you can put a little bit more, right? If you can increase your monthly payment to $100, it cuts down to only 2 years, and then you're only paying an extra like $400 in interest, okay? So be aware of that. Right, like I said, these types of calculations, I'm not going to ask you to do them. You need like a graphing calculator with a special program to be able to do them. And that's beyond the scope of this particular course, and you don't have graphing calculators at home right now. At least most of you don't. So that's not what I'm going to be asking you to do. The assignment is going to ask you to do some calculations, but nothing crazy like that. Okay, so again, looking at kind of a comparison here, right? What you can see is that if you're owing $1,000 at an 18% interest rate, you've kind of got, okay, well, here's 3 hypothetical options. What if you only make the minimum payment each month, right, of either 3% or $10? Based on this, 3% of $1,000 is going to be $30, so you'd be making $30 a month. Option B, what if you just try and do a little bit more? What if you do the minimum payment of $30 plus an extra $5? What's going to happen, right? And what if you do option C, where you just say, okay, I'm just going to do $100 a month all the time? What's that going to look like, right? And if we had the calculators and we did these calculations, again, I'm not asking you to do them. I'm asking you just to kind of look at the comparison here, right? Using just minimum payments, it's going to take you 10 years to pay off the original balance of $1,000. You're going to end up paying almost $800 in interest, right? Almost the same amount of the principal you're paying in interest, right? If you just bump it up by $5 a month, notice how it drops from 10 years to 6 years and 2 months. You've now saved 3 years and 10 months of having to make that payment. Even looking at the interest, you're now paying $500 in interest, not almost $800. So you're saving almost $300 in interest. If you go and you're able to bump it and say, okay, I'm going to pay $100 a month, I'm going to budget that into my monthly budget if this is how much I have to use to pay off my credit card, it's only going to take you 11 months to pay it off, and you're only going to pay $90 in interest, right? You're saving yourself 9 years of paying a credit card and $700 in interest, okay? So you do get a much, much more complicated situation, right? And that's what I'm trying to get you to see here is that, it said it was only 18% interest rate. It wasn't just simple interest calculated only off the principal amount that you borrowed of $1,000. If that was the case, the interest would have only been $180 for all of the options. It's not, because what's happening is that credit card interest rates are compounded interest, so we know that they're going to grow bigger and bigger and bigger, and they often are compounded daily. For every day you don't pay it off, they tack on a few more cents that what you owe them. Okay, so after that grace period, for every day you don't pay off your entire balance, you are being charged interest, right? Even making minimum payments, interest is still being charged for you for the remaining on your account. Be aware when it comes to credit cards. It gets dicey, okay? So that's the end of my little spiel there. I'm going to give you some questions for independent practice, right? Some of them are going to look like what we just did about like analyzing options on a card. Some of them will look like calculating minimum payments. Some of them will be looking at different cards and saying, well, what's pro, what's con, which card would you kind of go with there? And I am kind of giving you a little bit of a challenge in the sense of trying to calculate using a less intense method, the amount of interest owed. I explain it in the worksheet of how to do it. And then I've also provided the solution so if you get stuck, right? Don't forget to, if you're really not understanding what's going on, please get in touch with me. We can schedule a Google Meet session and I can explain it to you face-to-face over that online platform, okay? So as I mentioned, I think there's only 5 or 6 questions on that. Solutions are provided so you can check your work, see if you're doing okay. If you're not, shoot me an email, let me help you out as best as I can, okay? We'll have one more lesson on borrowing money, so looking at other types of loans, okay? And then after that, I will give you an assignment that's just on investing and borrowing money, okay? So the stuff that we've done from the investments and the stuff that we've looked at with credit cards, and then what we'll do in the next lesson, that will lead to an assignment that you will actually hand in on kind of investing and borrowing, and then that's the end of our financial math, and then we'll start looking at getting ready to do our last chapter of this course. Okay, so that's that.